The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, tax, legal, or investment advice. Every automotive repair business operates under unique circumstances, including varying state laws, tax obligations, and operational scales. You should conduct your own due diligence and consult with a certified public accountant, a qualified financial advisor, or a legal professional before making significant changes to your business software, accounting methods, or financial management strategies. The creator of this content is not responsible for any financial losses or legal issues that may arise from the application of the concepts discussed herein. You could be generating $1 million in top-line revenue this year and still be a dead shop walking. In the United States, historical trends suggest that nearly 40% of independent auto repair shops fail within their first 5 years of operation. The tragedy is that most of these shop owners are world-class technicians. They can diagnose a complex electrical ghost in a modern European sedan or rebuild a transmission blindfolded, but they are being bled dry by an invisible enemy: poor financial visibility. They see money coming in at the front counter, they see cars leaving the bays, yet at the end of the month, the bank account is hovering near zero and they cannot explain why. The question isn't just about whether you are working hard, it is about whether your money is working for you. Today, we are beginning a 10-part masterclass on the most controversial tool in the automotive back office. We are diving deep into the engine room of your business to answer the definitive question for 2026. Is QuickBooks the best choice for your auto repair shop? Or is it a generic solution that is costing you more in data friction than it saves in bookkeeping fees? This masterclass solves the single biggest headache for the modern American shop owner: the disconnect between the grease on the floor and the numbers on the screen. By the end of this series, you will understand how to structure your chart of accounts specifically for the automotive industry, how to handle the nightmare of parts returns and core charges without losing your mind, and how to determine if you need a specialized shop management system or if a streamlined QuickBooks setup is the lean, mean path to profitability. We are going to look at case studies of shops that transitioned from manual spreadsheets to automated cloud accounting and analyze the potential outcomes of various software integrations. If you have ever felt like your accounting software was a black box that you only looked at once a year during tax season, that ends today. To understand why QuickBooks has become the titan of the industry, we have to look at the historical trends of small business accounting in the United States. For decades, the general ledger was a physical book, then a complex desktop program that required a degree to navigate. QuickBooks entered the market and democratized accounting, making it accessible to the non-accountant. However, an auto repair shop is not a standard retail business. A standard retail store sells a widget. They buy it for $5 and sell it for $10. In the auto world, you are selling a complex cocktail of labor, highly volatile parts pricing, sublet services like specialized machining or glass repair, and hazardous waste disposals. Consider the complexity of a single water pump replacement. You aren't just selling a part. You are selling the technician's time, which is a perishable asset. If that technician sits idle for an hour, that inventory of time is gone forever. You are dealing with a parts supplier who might offer a list price, a garage price, and a fleet price. You have a core charge that must be tracked, collected from the customer, and then credited back when the old part is returned to the vendor. If your accounting software doesn't track that core return accurately, you are essentially throwing $20 to $50 into the trash every single time you do a heavy-duty job. Over a year for a high-volume shop, that can represent tens of thousands of dollars in lost potential outcomes that simply vanish because the software wasn't configured for the automotive workflow. QuickBooks, in its generic form, treats every business the same. Whether you are a freelance graphic designer or a heavy-duty diesel repair facility, the software starts with the same basic building blocks. This is where the QuickBooks trap begins for many shop owners. They install the software, use the default service business template, and suddenly find that their profit and loss statement is a mess. They cannot see their effective labor rate. They cannot see their parts margin versus their labor margin. They see one big bucket of income and one big bucket of expenses. This lack of granularity is why so many shops feel like they are guessing at their pricing. Let's look at a case study of a 3-bay shop in Ohio. The owner, let's call him Mike, was using QuickBooks Online for 3 years. On paper, Mike was profitable. His total income exceeded his total expenses. However, Mike was constantly struggling with cash flow. He couldn't understand why he didn't have the cash to upgrade his scan tools or hire a fourth tech. When we look at the historical data for shops like Mike's, we often find that the cost of goods sold, or COGS, is being recorded incorrectly. Mike was recording his parts purchases as an expense the moment he bought them, rather than tracking them as inventory or tying them directly to a specific repair order. Because his QuickBooks wasn't integrated with his shop management system, he had no way of seeing that his parts department was actually losing money on 20% of its tickets due to unbilled freight charges and forgotten core returns. The automotive industry requires a three-pillar financial approach: labor, parts, and overhead. In this masterclass, we will explore why QuickBooks often struggles with the first two. Labor is the most difficult asset to track. Unlike a physical product, you cannot count labor on a shelf. To be profitable in 2026, you need to know your tech productivity and your tech efficiency. If you are paying a tech for 40 hours a week but only billing out 30, you have a 10-hour leak. Generic accounting software like QuickBooks is not built to track clock-on/clock-off times against specific repair orders unless you pay for expensive add-ons or integrations. This means the shop owner is often flying blind, seeing the total payroll expense at the end of the week but having no idea if that labor was actually productive. Then there is the issue of the sink. Most modern shops use a shop management system, or SMS, such as ShopMonkey, Mitchell One, or TechMetric. These systems are the heart of the shop. They handle the estimates, the digital vehicle inspections, and the invoicing. These systems then sync their data to QuickBooks, which acts as the brain or the final ledger. This sync is where many financial disasters begin. If the mapping between the SMS and QuickBooks is even slightly off, your financial data becomes corrupted. You might find that your sales tax is being recorded as income, or your shop supplies fee is being buried in a miscellaneous category where it can't be analyzed. We are going to spend the next several parts of this series deconstructing the auto-specific chart of accounts. This is the foundational map of your business. If your map is wrong, it doesn't matter how fast you drive. You will never reach your destination. We will discuss why you need separate income accounts for labor income, parts income, sublet income, and shop supplies. We will look at why cost of goods sold needs to be mirrored exactly to those categories so you can see your gross profit margins in real time. Historical trends in the U.S. aftermarket show that a healthy shop should aim for roughly 65% gross profit on labor and 45% on parts. If your QuickBooks is just showing you total sales, you have no way of knowing which part of your business is carrying the weight and which part is a sinking ship. As we move forward, we will also address the QuickBooks Online versus desktop debate, which has become a point of major contention in the industry as Intuit pushes more users toward the subscription-based cloud model. We will analyze the data on data security and accessibility for multi-location shops versus the feature richness and one-time cost of the legacy desktop versions. This is a deep dive into the financial soul of your garage. Managing your shop's finances isn't just about doing taxes. It is about having a dashboard that tells you every single morning exactly how much it costs to keep your doors open and exactly how much value you are creating. If you are ready to stop fixing cars for a moment and start fixing your business, we are just getting started. This masterclass is designed to take you from a technician who owns a shop to a CEO who understands the mechanics of money. Would you like me to move on to part 2, where we break down the specific chart of accounts every auto shop needs to stop the bleeding? The foundation of every profitable auto repair shop in 2026 is not the scan tool or the 4-post lift. It is the chart of accounts. Most shop owners treat their chart of accounts like a junk drawer, throwing every expense and every dollar of income into a few broad categories. If your QuickBooks simply shows sales and expenses, you are flying a plane with a broken altimeter. You might feel like you are at 30,000 feet, but you could be seconds away from hitting a mountain. To move from a technician mindset to a CEO mindset, we have to rebuild your chart of accounts to reflect the specific high-velocity nature of automotive repair. In the United States, historical trends indicate that shops with a granular chart of accounts have a significantly higher probability of identifying margin bleed before it becomes a cash flow crisis. Imagine a shop owner named David in Phoenix, Arizona. David runs a successful 5-bay shop specializing in domestic trucks. In 2025, David saw his highest revenue ever, yet his personal take-home pay stayed flat. When we looked at his QuickBooks, he had one account for income. This is the first mistake. In an auto shop, not all revenue is created equal. You must separate your labor income from your parts income. Why? Because your profit margins on these two items are drastically different. Labor is your highest margin product. often yielding 60 to 70% gross profit. Parts are a lower margin, high-volume game, usually targeting 40 to 50%. If David lumps them together, he cannot see if his service writers are discounting labor to sell the job, which effectively kills his most profitable asset. Step 1 in this masterclass is creating separate income accounts for every major revenue stream. You need labor income, parts income, sublet income, and shop supplies income. Sublet income is critical because it represents work you outsourced, like a specialized alignment or a glass replacement. If you don't track it separately, you might be paying a vendor more than you are charging the customer without even realizing it. Shop supplies is another hidden gold mine. Historical trends suggest that many shops fail to collect enough in supply fees to cover the rising costs of brake cleaner, gloves, and rags in 2026. By tracking this as a separate income line, you can compare it directly to your shop supplies expense and ensure that this category is at least break-even or, ideally, a small profit center. Now we move to the cost of goods sold section, or COGS. This is where most shops lose the war. Your COGS must mirror your income accounts exactly. If you have labor income, you must have a labor COGS, which includes the wages and burden for your technicians. If you have parts income, you must have a parts COGS. This allows for a side-by-side analysis. If your parts income was $50,000 last month and your parts COGS was $35,000, you immediately know your parts margin was 30%. If your target was 45%, you now have a specific problem to solve. You don't have a revenue problem. You have a parts pricing or purchasing problem. This level of detail removes the guesswork from your Saturday morning strategy sessions. Let's look at a case study of a shop in Georgia that struggled with sublet COGS. The owner, Sarah, noticed her total profit was dipping. By breaking out her sublet accounts, she discovered that her sublet window tinter had raised prices by 15%, but her service advisors were still using the 2024 price list. Because it was all buried in a general parts and materials account previously, Sarah had lost over $8,000 in potential outcomes over 6 months. Once the chart of accounts was refined, the leak was visible within 30 days. Another critical area is the labor burden within your COGS. Many shop owners only record the hourly wage of the tech. In 2026, the true cost of a technician includes employer-paid taxes, workers' compensation insurance, health benefits, and retirement contributions. If you are paying a tech $35 an hour, their burden costs might be closer to $48. If your chart of accounts doesn't reflect this total cost in your labor COGS, your gross profit on labor is a lie. You are making less than you think, which means you are likely underpricing your menu services like oil changes and brake jobs. We also need to discuss inventory versus expense. In the United States, many small shops use cash basis accounting, where they expense parts the moment they buy them. This is a trap for shops that keep a significant amount of oil, filters, or common tires on hand. If you buy $5,000 worth of tires in December but don't sell them until January, your December looks like a disaster and your January looks like a miracle. Neither month reflects reality. By setting up an inventory asset account in QuickBooks, you can track the value of what is sitting on your shelves. This provides a more accurate historical trend of your shop's actual performance month over month. Beyond the COGS, we must organize your operating expenses, or fixed costs. These are the costs that stay the same whether you fix 10 cars or 100. This includes rent, utilities, software subscriptions, and administrative payroll. A common mistake in 2026 is subscription creep. Between your shop management system, your digital inspection software, your marketing suite, and your accounting software, many shops are spending thousands of dollars a month on SaaS or software as a service. If these are all lumped into office expenses, you cannot see the impact on your break-even point. You should have a dedicated account for software and technology, so you can evaluate the return on investment for every digital tool you use. Imagine if you could see at a glance that your marketing spend was 3% of your gross revenue, but your return on ad spend was declining. With a clean chart of accounts, this data is at your fingertips. Without it, you are just writing checks and hoping for the best. We are building a command center here. The goal of this part 2 is to ensure that your QuickBooks isn't just a place where data goes to die, but a living map of your business's health. By categorizing every dollar with precision, you create financial visibility. This visibility allows you to make data-driven decisions rather than gut-feeling decisions. Consider the potential outcomes of a shop that tracks training and education as a separate line item. In 2026, with the rapid advancement of electric vehicles and complex ADAS systems, technician training is a mandatory investment. If you see that you are only spending 0.5% of your revenue on training, you can predict a future skill gap that will lead to more comebacks and lower efficiency. The chart of accounts isn't just about the past, it's a leading indicator of your shop's future. As we conclude this deep dive into the chart of accounts, you should have a clear vision of your new income, COGS, and expense categories. But having the right categories is only half the battle. The real magic happens when your shop management system talks to QuickBooks without human intervention. If you are still manually entering invoices into QuickBooks at the end of the day, you are prone to data entry fatigue and keying errors. In the next part of this masterclass, we are going to look at the digital handshake. We will explore how to automate the flow of data from your front counter to your back office, so you can spend more time growing your business and less time staring at a spreadsheet. But there is a hidden danger in automation: the garbage in, garbage out syndrome. How do you ensure that your automation is actually accurate? We will find out in part 3. The digital handshake is the process where your shop management system, or SMS, communicates with QuickBooks. In 2026, this is no longer a luxury. It is a requirement for survival. If you are a shop owner like Marcus in Charlotte, North Carolina, and you are still manually rekeying invoices from your point-of-sale system into QuickBooks every Friday night, you are not just wasting time. You are introducing a statistical certainty of error. Historical trends in data entry show that for every 100 keystrokes, a human will make an average of 1 to 3 errors. In a high-volume shop doing 20 cars a day, those errors compound into a financial fog that makes it impossible to see your true profit margins. Imagine if every time a technician added a set of brake pads to a repair order, that data flowed instantly into your accounting ledger, categorized correctly, with the tax calculated and the vendor bill pre-populated. This is the potential outcome of a properly configured integration. Most modern SMS platforms like ShopMonkey, TechMetric, or Mitchell One have native QuickBooks Online integrations. They use a method called mapping. Mapping is essentially a set of instructions that tells the SMS where to put the money. For example, you tell the system that any revenue categorized as labor in the SMS should land in the 4,000 labor income account in QuickBooks. However, this is where the garbage in, garbage out syndrome takes hold. If your mapping is sloppy, your automation becomes a weapon of mass confusion. A common case study involves a shop in Texas that realized their sales tax liability in QuickBooks didn't match their actual sales. Upon investigation, they found that their SMS was mapping shop supplies as a non-taxable item in QuickBooks, even though they were legally required to collect tax on them in their jurisdiction. Because they trusted the automation blindly, they underreported their tax liability for 18 months. This is why the digital handshake requires a weekly audit. You cannot set it and forget it. You must verify that the total sales in your SMS matches the total deposits in your QuickBooks to the penny. To ensure your automation is accurate, you need to understand the two primary ways systems talk to each other: summary sync and individual invoice sync. A summary sync takes all the activity from a single day and pushes it into QuickBooks as one giant journal entry. This keeps your QuickBooks clean and easy to manage, but it robs you of granular detail. If you need to look up a specific customer's payment history from 3 months ago, you won't find it in QuickBooks. You will have to go back to the SMS. On the other hand, an individual invoice sync pushes every single repair order as a unique invoice into QuickBooks. This gives you incredible detail but can clutter your ledger if you are a high-volume shop. For most independent shops in 2026, the individual invoice sync is preferred because it allows for better tracking of core returns and specific part warranties. Let us look at the step-by-step details of a successful sync setup. First, you must clean your chart of accounts in QuickBooks, as we discussed in the previous part. If the categories in your SMS don't have a matching home in QuickBooks, the sync will fail or worse, create duplicate accounts. Second, you must decide on your point of sync. Does the data move when the estimate is created, when the job is authorized, or only when the invoice is closed and paid? Historical trends suggest that syncing only upon payment is the safest route to prevent phantom income from skewing your books. If you sync an invoice before it is paid, QuickBooks thinks you have that money, even if the car is still sitting in your lot waiting for a customer who might have a declined credit card. Another layer of the digital handshake is the automated bank feed. In 2026, QuickBooks can connect directly to your business checking and credit card accounts. This allows you to match the money coming in from your SMS sync to the actual cash hitting your bank account. This is the ultimate check and balance. Imagine a scenario where your SMS says you collected $5,000 on Tuesday, but your bank feed only shows $4,800. This immediate red flag allows you to catch errors like a service advisor forgetting to record a cash payout for a parts delivery or a credit card processing fee that was higher than expected. Without this automated matching, that $200 discrepancy might go unnoticed for months. Case studies of elite shops in 2026 show a heavy reliance on class tracking within the QuickBooks integration. Class tracking allows you to categorize transactions by location or by department. If you have a shop that does both general repair and specialized performance tuning, you can use classes to see which department is actually paying the bills. You can see the specific profit and loss for the performance side versus the maintenance side. This is powerful because it allows you to allocate resources based on data. If the performance side has a higher gross profit but requires double the overhead, your QuickBooks will finally tell you that truth. Step by step, you should also be integrating your parts vendors. Major players like Worldpac, Advance Auto Parts, and AutoZone often have integrations that allow their digital invoices to flow directly into your SMS, which then flows into QuickBooks. This creates a closed-loop system. When the parts bill arrives, it should automatically match the parts COGS entry created when the repair order was closed. This eliminates the nightmare of statement reconciling at the end of the month. You no longer have to sit with a stack of greasy paper invoices trying to figure out why your NAPA statement is $300 higher than what you thought you owed. The software identifies the missing invoice or the uncredited core return for you. However, the human element remains the biggest risk factor. Even with perfect software, if a service advisor selects the wrong category at the front counter, the automation will faithfully push that error into your permanent financial records. This is why training your front office staff on the financial impact of their button clicks is essential. They aren't just opening a ticket, they are initiating a series of financial transactions that affect your tax liability, your profit margins, and your ability to pay bonuses. In 2026, a top-tier service advisor understands the flow of money, as well as they understand the flow of traffic in the bays. We have now covered the map and the bridge between your systems. Your chart of accounts is ready, and your digital handshake is moving data. But there is a silent killer lurking in many American shops that even the best automation can struggle to track: inventory bloat. In an era of supply chain volatility and rising parts costs, having too much money tied up in dead stock on your shelves can starve your business of the cash it needs to grow. How do you use QuickBooks to manage your physical inventory without it becoming a full-time job? And more importantly, how do you handle the parts that never made it onto a car? We are diving into the inventory black hole in Part 4. The math behind your stocking levels might be the difference between a record year and a total collapse. Are you ready to see what is actually sitting on your shelves? The inventory black hole is a phenomenon that destroys the liquidity of otherwise successful American auto shops. In 2026, the cost of parts has reached historical highs due to sophisticated sensor integration and specialized materials. If you are a shop owner like Elena in Denver, Colorado, you might feel like you are doing well because your bays are full, but your bank account tells a different story. When we look into the dark corners of the parts room, we often find thousands of dollars in dead capital. This is money that you have already spent, which is now sitting on a shelf collecting dust instead of being in your operating account to pay for technician training or new equipment. QuickBooks can be your greatest ally or your biggest source of confusion when it comes to managing this physical asset. To master inventory in QuickBooks, you first have to understand the difference between non-inventory parts and inventory parts. Most shops should treat 90% of their parts as non-inventory. These are the parts you order specifically for a job in progress. You order a water pump from your local warehouse, it arrives, you install it, and you bill the customer. In this scenario, the money flows in and out almost simultaneously. However, for high-turnover items like premium synthetic oil, common oil filters, and wiper blades, you need to use the inventory part feature in QuickBooks. This allows the software to track exactly how many units you have on hand and, more importantly, what you paid for them. Imagine if you buy 100 oil filters at $5 each. That is $500 of your cash that has now vanished from your bank account and transformed into a physical asset. If you just expense that $500 immediately, your profit and loss statement for that month will show an artificially high expense. Then, over the next 3 months as you sell those filters, Your profit will look artificially high because you have no corresponding expense for those specific sales. This sawtooth effect, in your financial reporting, makes it impossible to predict your monthly cash flow. By using the inventory asset account, QuickBooks keeps that $500 on your balance sheet as an asset. It only moves that cost over to your profit and loss statement as an expense the moment you actually sell a filter. This is called the accrual method of accounting, and for a shop in 2026, it is the only way to see your true margins. Step by step, managing this in QuickBooks requires a disciplined receiving process. When the delivery truck drops off those filters, someone in your shop, perhaps a dedicated parts manager or a lead service advisor, must receive those items into QuickBooks against the vendor's bill. This updates your quantity on hand. If you skip this step and just sell the parts through your shop management system, your inventory levels will go into the negative, and your financial data will become a mess of automatic adjustments that no accountant can untangle. Historical trends show that shops that perform a physical count once a month and reconcile it against their QuickBooks data have a 20% higher parts margin than those who don't. This is because the physical count identifies shrinkage, which is a polite way of saying parts that were used but never billed, or parts that simply walked out the back door. Let us look at a case study of a transmission shop in Florida. The owner, Robert, realized he was spending $60,000 a month on parts, but only showing $45,000 in parts sales. He was losing $15,000 every single month to the inventory black hole. After implementing a strict inventory tracking system in QuickBooks, he discovered that his technicians were frequently grabbing small parts like gaskets and seals from the bulk bins without adding them to the repair orders. Individually, these were $5 items. Collectively, they were costing him nearly $200,000 a year in potential outcomes. By creating assembly items in QuickBooks, which bundles several individual parts into one searchable kit, Robert made it easier for his team to bill the entire job correctly, closing the leak almost overnight. The most dangerous part of the inventory black hole is core charges. In 2026, a core charge on a high-end alternator or a hybrid battery pack can be several $100s. If your QuickBooks is not set up to track cores at vendor, you are essentially giving interest-free loans to your parts suppliers. You must have a specific other current asset account labeled cores to be returned. When you buy a part with a core, that core value goes into this account. When the driver picks up the old part and hands you a credit memo, you move that value out of the asset account and back into your cash or accounts payable. If you don't do this, those cores stay on your books as value that you don't actually have, leading you to believe your business is worth more than it is. Consider the potential outcomes of stocking levels based on data rather than gut feeling. In 2026, the cost of carry is real. This includes the cost of the space to store the parts, the insurance to cover them, and the risk of obsolescence. If you are stocking parts for a 2018 vehicle that is rarely seen in your area anymore, that is dead stock. QuickBooks allows you to run an inventory valuation summary report. If you see a part that hasn't moved in 180 days, it is time to return it for a restocking fee or sell it at a discount to get your cash back. Cash in the bank is always better than a part on the shelf that nobody wants. Another layer of this masterclass involves volume purchasing. Many shops are tempted by buy 10, get 2 free deals from vendors. While this looks like a great way to lower your cost of goods sold, it can be a trap. If it takes you a year to sell those 12 items, the opportunity cost of that tied-up cash might exceed the savings you gain from the free units. In 2026, with interest rates fluctuating, that cash could have been earning 4% in a high-yield business savings account or being used to pay down a high-interest equipment loan. We call this just-in-time versus just-in-case inventory. Most successful shops are moving toward a just-in-time model for everything except the most basic consumables. Imagine if your QuickBooks could tell you the turnover rate of every item you stock. This isn't science fiction. It is standard data analysis. A healthy shop should aim for an inventory turnover rate of 4 to 6 times per year. If your turnover is only 2, you are overstocked. If it is 12, you are likely losing efficiency because your techs are waiting for parts to be delivered. Finding that Goldilocks zone is the secret to a high-performance back office. We have addressed the physical parts and the cores, but what about the internal parts? Many shops perform maintenance on their own tow trucks, loaner cars, or shop equipment. If you take an oil filter from your inventory and put it on your shop's delivery truck, you must adjust that inventory out of QuickBooks and expense it to vehicle maintenance. If you don't, your parts margin will look lower than it actually is because you sold a part for $0. This is a common error that makes a shop look less efficient to a potential buyer or a bank. Managing the inventory black hole requires a shift in culture. It is not just a bookkeeping task. It is an operational standard. But even with perfect inventory, your shop's financial health is still at the mercy of one of the most stressful aspects of the business: accounts payable. How do you handle the mountain of vendor statements, the varying terms like 2% 10 net 30, and the constant stream of credits? In Part 5, we are going to look at the vendor power play. We will show you how to use QuickBooks to gain leverage with your suppliers and ensure you never pay a penny more than you owe. Are you ready to stop being a check-writing machine and start being a negotiator? The next part might just save you more money than your last 10 break jobs combined. The vendor power play is where you stop being a passive payer and start being a strategic partner with your suppliers. In the high-stakes world of automotive repair in 2026, your parts vendors are not just delivery services. They are essentially your largest creditors. If you look at your balance sheet right now, your accounts payable, the money you owe to others, is likely dominated by 3 or 4 major parts warehouses. If you are a shop owner like Jackson in Nashville, Tennessee, you might be overwhelmed by the sheer volume of daily invoices. It is common for a busy shop to receive 15 to 30 separate invoices a day. If you are not using QuickBooks to manage this flow, you are likely losing thousands of dollars a year in missed credits, double billings, and lost early payment discounts. To master the vendor power play, you must move away from the shoebox method of handling bills. Many shop owners wait until the end of the month, receive a statement from their primary vendor, and simply write a check for the total amount shown. This is a massive mistake. Historical trends show that vendor statements are frequently inaccurate. They might include parts you returned but weren't credited for, or they might miss a discount you were entitled to under your shop-level pricing agreement. Instead of paying the statement, you should be paying the bills in QuickBooks that you have personally verified. Step by step, the process begins with entering bills daily. When that delivery driver leaves a slip on your counter, it needs to be entered into QuickBooks immediately. This does 2 things: it records the expense in the correct period, and it creates a liability that you can track. If you wait until the end of the month, you are looking at the past through a rearview mirror. If you enter them daily, you are looking through the windshield. By entering the bills as they arrive, you can use the accounts payable aging report to see exactly who you owe and when it is due. This is where your leverage begins. Let us look at a case study of a specialized European shop in Seattle. The owner, Thomas, noticed that his primary parts supplier offered 2% 10 net 30 terms. This means if he paid the bill within 10 days, he got a 2% discount. Otherwise, the full amount was due in 30 days. Thomas thought 2% was too small to worry about. However, when we looked at his annual parts spend of $400,000, that 2% represented $8,000 in pure profit, enough to pay for a high-end diagnostic subscription for the entire year. By using the Pay Bills feature in QuickBooks, Thomas set up a weekly schedule to catch every single discount. He wasn't working harder. He was just using his software to keep more of his own money. The next level of the power play is credit memo management. This is the single most neglected area of shop finance. In a typical week, your shop might return 3 wrong parts, 2 defective starters, and 4 cores. Each of those should result in a credit memo from the vendor. If you are not recording these as vendor credits in QuickBooks, you are relying on the vendor's honesty and their driver's paperwork accuracy. Historical data suggests that up to 15% of return credits are lost in the shuffle between the shop and the warehouse. Imagine if you are returning $10,000 worth of parts and cores a month. If 15% goes missing, you are lighting $1,500 on fire every single month. In QuickBooks, you must create a credit memo the moment that part leaves your building. This puts a negative balance on that vendor's account. When you go to pay your next bill, QuickBooks will remind you that you have those credits available. You apply the credit, and your check or ACH transfer is reduced by that amount. This is how you ensure you never pay a vendor for a part that is no longer in your shop. Imagine a scenario where a vendor claims you owe them $5,000, but your QuickBooks says you only owe $4,200 because of outstanding credits. Without your own data, you have no ground to stand on. With QuickBooks, you can print a vendor balance detail report and show them exactly which credits are missing. This turns a he said, she said argument into a data-driven negotiation. In 2026, the vendors with the best technology are the ones who get paid accurately, and the shops with the best data are the ones who get the best service. Another critical aspect of the vendor power play is price verification. Parts prices are fluctuating faster than ever. If your shop management system is integrated with QuickBooks, you can run reports to see if your unit cost for a common brake rotor has climbed 10% over the last quarter. If your revenue hasn't climbed to match, your margin is being compressed. You can use this data to go back to your vendor and say, "I see my cost has increased significantly. What can we do to keep my shop competitive?" Vendors often have tiered pricing that they don't offer unless you ask. Having the QuickBooks data to prove your volume and your loyalty gives you the upper hand. Consider the potential outcomes of consolidated purchasing. By looking at your expenses by vendor report in QuickBooks, you might find that you are buying small amounts of supplies from 6 different companies. Each of those companies is charging you a separate delivery fee or a fuel surcharge, which has become a standard line item in 2026. By consolidating those purchases to 1 or 2 primary vendors, you can often negotiate the removal of those fees or secure a higher volume discount tier. This visibility is only possible when your vendor data is clean and categorized. We also need to discuss ACH and virtual cards. In 2026, writing paper checks is becoming obsolete and expensive. QuickBooks allows you to pay vendors via ACH directly from the software. This not only saves on postage and envelopes, but also gives you a precise, digital paper trail. Some shops are even using virtual credit cards for vendor payments to earn cashback rewards. If you spend $50,000 a month on parts and use a card with a 1.5% cashback rate, that is an extra $9,000 a year in other income. However, you must be disciplined. If you carry a balance and pay interest, the power play backfires. You must use QuickBooks to ensure you have the cash on hand to pay that card in full every single month. Step by step, your goal should be to reach a zero balance reconciliation every month. This means your QuickBooks accounts payable account matches the vendor's statement perfectly. If there is a 5-cent discrepancy, you find it. This level of precision sends a message to your vendors. This shop knows its numbers. When a vendor knows you are watching the pennies, they are much less likely to let the dollars slip through the cracks. We have mastered the map, the handshake, the inventory, and the vendors. Your back office is starting to look like a well-oiled machine. But there is one more gear in this engine that is often the most difficult to calibrate: labor. Your technicians are your most expensive and most valuable asset. But how do you know if you are actually making money on their time? How do you account for unapplied labor, efficiency, and productivity in a way that QuickBooks can understand? In Part 6, we are going to dive into the human capital equation. We will show you how to track payroll not just as an expense, but as an investment with a measurable return. Are you ready to see the true cost of that empty bay or that slow tech? The math might shock you. In the automotive world, we often say that we sell parts, but the truth is we sell time. Time is the most perishable commodity in your shop. Once an hour passes without a technician turning a wrench on a billable job, that inventory is gone forever. In 2026, labor rates across the United States have climbed significantly to keep pace with the technical complexity of modern vehicles. If you are a shop owner like Carlos in Miami, Florida, your payroll is likely your largest monthly outgoing. However, most shops treat payroll as a lump sum expense in QuickBooks. They see a total number like $20,000 for the biweekly run and simply categorize it as wages. This is a missed opportunity for a massive competitive advantage. To truly manage your shop, you must view labor through the lens of the human capital equation. Step by step, the first move is to split your payroll in QuickBooks between direct labor and indirect labor. Direct labor is the money you pay to the technicians who are actually producing revenue in the bays. Indirect labor includes your service advisors, your shop foreman who spends more time managing than wrenching, your parts driver, and your administrative staff. By separating these two in your chart of accounts, you can calculate your gross profit on labor. Historical trends in high-performing shops show that for every dollar you spend on a technician's fully burdened wage, you should be aiming to generate at least $3 to $4 in labor revenue. If your QuickBooks shows you are paying out $10,000 in tech wages but only bringing in $15,000 in labor sales, your multiplier is only 1.5. You are essentially trading dollars, and after overhead, you are likely losing money on every car that enters the bay. Let us look at a case study of a general repair shop in Ohio. The owner, Brenda, had 3 technicians, 1 master tech and 2 B-level techs. On paper, her total payroll was within the industry standard of 30% of gross sales. However, her cash flow was tight. We helped her set up class tracking in QuickBooks to track labor costs by technician. The data revealed a shocking trend. Her master tech, who was paid $45 an hour, was highly efficient and producing a 4.2x multiplier. One of her B-level techs, however, was struggling with newer diagnostic equipment and was only producing a 1.8x multiplier. Because the wages were all lumped together previously, the master tech was essentially subsidizing the underperformance of the junior tech. Once Brenda saw this data in her QuickBooks reports, she didn't fire the junior tech. She invested in specific training for the equipment he struggled with. 6 months later, his multiplier rose to 2.8x, adding thousands to the shop's bottom line. Imagine if you knew exactly what it cost you when a technician was standing around because a parts delivery was late. This is what we call unapplied labor. In a perfect world, if you pay a tech for 8 hours, they bill for 8 hours. In the real world, there are morning meetings, cleaning the shop, moving cars, and waiting for parts. If you want to get truly deep into the masterclass level of QuickBooks management, you should use the timesheet feature or an integrated payroll app like QuickBooks Time. Technicians can clock into specific repair orders. This allows you to see the delta, or the difference between paid hours and billable hours. If your shop is paying for 200 hours of labor a week, but only billing 140, you have 60 hours of unapplied labor. At a shop rate of $150 an hour, that is $9,000 a week in lost potential outcomes. To account for this accurately, you need to understand the concept of the fully burdened labor rate. As we touched on earlier, the hourly wage is just the beginning. In 2026, a shop owner in the US has to account for FICA, FUTA, SUTA, workers' comp, health insurance, and perhaps a 401k match. If you are not including these costs in your labor COGS in QuickBooks, your profit margins are overstated. Let's say you pay a tech $30 an hour. By the time you add all the burdens, that tech actually costs you $42 an hour. If you are using a flat rate manual that says a job takes 2 hours, and your labor rate is $100, you think you made $158 in profit. But if that tech actually took 3 hours because they were distracted, your cost jumped to $126, and your profit shriveled to $74. QuickBooks helps you catch these silent killers of profitability by allowing you to run job costing reports. Job costing is the process of assigning every expense, both parts and labor, to a specific job. In 2026, most top-tier shop management systems handle the heavy lifting here, but the data must be reconciled in QuickBooks. Imagine if you could look at every engine swap you did last year and see the average net profit. You might find that while engine swaps bring in high revenue, the labor comebacks, or the complexity of the jobs makes them less profitable than doing 20 brake jobs and 30 oil changes. This data allows you to pivot your marketing. Instead of chasing big jobs, you might find that your shop's sweet spot is high-volume maintenance. Another critical factor is tech efficiency versus tech productivity. Productivity is how much of the tech's time was spent on a car. Efficiency is how fast they did the job compared to the labor guide. If a tech is productive but not efficient, they are taking too long. If they are efficient but not productive, they are fast, but you don't have enough work to keep them busy. QuickBooks can't tell you why a tech is slow, but it can tell you that the labor margin for that tech's work is falling below the historical trend. This is the signal you need to step out of the office and onto the shop floor to investigate. Are the tools insufficient? Is the service advisor not providing enough detail on the work order? Is the tech simply needing more coaching? Consider the potential outcomes of a performance-based bonus system. Many shops in 2026 are moving away from straight hourly pay to a base plus bonus model. You can use QuickBooks to track these bonuses by setting up payroll items linked to specific production goals. When a tech exceeds a certain multiplier or maintains a comeback rate of less than 1%, the bonus is triggered. This aligns the technician's goals with the shop owner's goals. When the shop makes more, the tech makes more. By tracking this in QuickBooks, you ensure that the bonuses are paid out of found money from increased efficiency, rather than eating into your existing margins. We must also discuss the owner's compensation. In many small shops, the owner is also the lead tech or the service advisor. A common mistake is not paying yourself a fair market wage. If you are living off the profit rather than taking a salary, your QuickBooks data is skewed. Your shop might look profitable, but it's only because it has free labor from the owner. In 2026, to truly value your business, you must record your own labor at what it would cost to hire someone else to do that job. This gives you a true profit figure that reflects the health of the business independent of your personal heroics. We have now deconstructed the parts, the vendors, and the people. Your financial engine is tuned, and the data is flowing. But even a perfect engine won't get you anywhere if you are driving toward a cliff. The ultimate goal of all this QuickBooks work is to generate the big three reports: the profit and loss, the balance sheet, and the statement of cash flows. Most shop owners look at the P&L and stop there. But the P&L can lie to you. It can show you are making money, while your bank account is empty. In Part 7, we are going to dive into the truth beyond the P&L. We will show you how to read your balance sheet to find hidden dangers, and how to manage your cash flow, so you never have to sweat a Friday payroll again. Are you ready to see the full picture? The most important numbers in your business are the ones you probably aren't looking at yet. The profit and loss statement is the most popular report in QuickBooks, but in the world of automotive repair in 2026, it is often the most deceptive. You can look at a P&L that shows a net income of $20,000 for the month, and yet find yourself unable to pay your parts bill or cover your Friday payroll. This is the great disconnect that haunts shop owners like Derek in Indianapolis. Derek's P&L told him he was winning, but his bank balance told him he was drowning. To understand the truth, we must move beyond the P&L and master the two silent giants of accounting: the balance sheet and the statement of cash flows. These reports do not just tell you what you earned, they tell you where the money actually went. The balance sheet is a snapshot of your shop's health at a specific moment in time. It is divided into assets, liabilities, and equity. In an auto shop, your assets aren't just the cash in your drawer. They include your accounts receivable, the money customers owe you, your inventory on the shelves, and your cores waiting to be returned. Your liabilities are what you owe to others, such as your credit card balances, your parts vendor accounts payable, and any equipment loans for those new ADAS calibration tools you purchased this year. The formula is simple: assets minus liabilities equals equity. If your liabilities are growing faster than your assets, your shop is losing value even if the P&L shows a profit. Imagine a scenario where your P&L shows a high profit because you did 10 high-dollar engine replacements. However, because those were fleet customers on net 30 terms, you haven't actually received the cash. Your P&L records the revenue the moment you close the invoice, but your balance sheet shows that money sitting in accounts receivable. Meanwhile, you had to pay your technicians' wages and the parts vendor immediately. This is how a profitable shop goes bankrupt. Historical trends in the U.S. automotive aftermarket show that cash gap management is the primary reason shops fail during growth phases. They grow so fast that their cash is tied up in receivables and inventory, leaving nothing for operations. Step by step, you must use QuickBooks to perform a weekly balance sheet review. Look at your accounts receivable aging. If you have fleet accounts or insurance claims that are over 60 days old, that is stagnant capital. That is your money being used by someone else for free. By identifying these laggards, you can implement a collections process or change your terms to due on receipt. Next, look at your current ratio. This is your current assets divided by your current liabilities. In 2026, a healthy shop should aim for a ratio of 2.0 or higher. This means for every dollar you owe in the short term, you have $2 in assets to cover it. If your ratio is below 1.0, you are in a liquidity crunch, and every unexpected equipment failure or comeback becomes a financial emergency. Case studies of successful shops in California show a heavy reliance on the statement of cash flows. This report is the bridge between the P&L and the balance sheet. It starts with your net income, and then adds or subtracts the changes in your balance sheet accounts to show the actual net change in cash. If your inventory increased by $5,000 this month, the statement of cash flows will subtract that $500 from your profit because that cash is now sitting on a shelf. If you paid down $10,000 of a loan, that doesn't show up on your P&L as an expense, but it definitely left your bank account. The statement of cash flows captures that exit. Consider the potential outcomes of loan principal payments. Many shop owners get frustrated because they see a $10,000 profit on their P&L, but their bank account only grew by $2,000. They forget that the $8,000 principal payment on their shop mortgage or their scan tool lease is not a tax-deductible expense that lowers profit. It is a reduction of liability on the balance sheet. By tracking this in the statement of cash flows, you can finally reconcile your mental math with the software math. This clarity reduces the stress of missing money and allows you to plan for future investments with precision. Now let's talk about the tax trap. In 2026, the IRS and state taxing authorities are more integrated with digital payment platforms than ever. A common historical trend among struggling shops is borrowing from the government. This happens when a shop uses the sales tax they collected or the payroll taxes they withheld to pay their parts bill. In QuickBooks, these are liabilities. They are not your money. If you look at your balance sheet and see a large sales tax payable balance, but your cash account is lower than that balance, you are in trouble. You have spent money that belongs to the state. Elite shop owners use QuickBooks to auto-transfer these tax liabilities into a separate tax savings bank account every week. This ensures that when the quarterly or monthly filing is due, the cash is ready and waiting. Imagine if you could predict a cash shortage 3 weeks before it happened. This is the power of cash flow forecasting in QuickBooks. By looking at your historical trends of when customers pay and when major bills like rent and insurance are due, you can create a pro forma look at your bank balance. If you see a valley approaching where your balance dips near zero, you can take action today. You can run a flash sale on maintenance services to bring in quick cash, or you can talk to your primary vendor about an extension on your statement. Proactive management is always cheaper than reactive scrambling. Step by step, you should also be monitoring your debt-to-equity ratio. In an era of high interest rates, carrying too much debt to finance shop equipment can be a profit killer. If your interest payments are eating up 10% of your gross revenue, you are working one day every 2 weeks just to pay the bank. QuickBooks allows you to see the interest expense clearly. If you see this number climbing, it might be time to pause equipment acquisitions and focus on internal efficiency to pay down existing high-interest debt. The balance sheet also reveals the true value of your business if you ever decide to sell. A buyer doesn't just look at your sales, they look at your net worth. If your QuickBooks shows a clean balance sheet with low debt, high-quality inventory, and modern equipment that is mostly paid off, your multiple, or the price a buyer is willing to pay, increases significantly. By managing your balance sheet today, you are essentially building an exit for tomorrow. We have explored the depths of the financial reports and found the hidden truths that the P&L tries to hide. Your shop is now financially transparent. You know where every cent is, who owes you, and who you owe. But even with this knowledge, there is a technical hurdle that stops many shop owners in their tracks: the platform choice. Should you be using QuickBooks Online for its cloud-based flexibility? Or is the old-school QuickBooks Desktop still the heavy-duty champion for the automotive industry in 2026? In Part 8, we are going to have the ultimate software showdown. We will look at the data on speed, integration, and cost to help you decide which version is the right engine for your specific shop's needs. The choice you make here will dictate how you work for the next 5 years. Are you ready to pick your platform? The software showdown between QuickBooks Online and QuickBooks Desktop is the automotive industry's equivalent of the gas versus electric debate. In 2026, Intuit has made its stance clear by sunsetting several desktop features, yet many of the highest-grossing independent shops in the United States still cling to the desktop version like a classic muscle car. If you are a shop owner like Anthony in Detroit, Michigan, you are facing a critical crossroads. Choosing the wrong platform can result in data lag, broken integrations with your shop management system, or a monthly subscription bill that feels like a second mortgage. To make an informed decision, we must analyze the performance data, the technical architecture, and the historical trends of both platforms. QuickBooks Online, or QBO, is the modern standard for accessibility. In 2026, the primary advantage of QBO is the anywhere, anytime factor. Imagine if you are at a training seminar in another state and you need to check if a specific fleet customer paid their $5,000 invoice. With QBO, you pull up the app on your phone and see the live data. Historical trends show that shops moving to QBO save an average of 4 hours a week on data syncing, because the bank feeds and merchant services are native to the cloud. You don't have to back up your data or worry about a local hard drive failure, wiping out your 2025 tax records. The software updates itself automatically, ensuring you are always compliant with the latest tax tables and 1099 reporting requirements. However, the cloud tax is a real factor. In 2026, QBO operates on a tiered subscription model. For an auto shop that requires class tracking and inventory management, you are likely looking at the Plus or Advanced tiers. These costs can exceed $200 a month. Over 5 years, that is $12,000 in software fees. For a lean shop, this is a significant operating expense that must be weighed against the efficiency gains. Furthermore, QBO relies entirely on your internet connection. If your shop is in a rural area with spotty service, a cloud outage means your back office is effectively paralyzed. You cannot enter bills, you cannot check customer balances, and you cannot run payroll until the connection returns. Now let us look at the legacy champion, QuickBooks Desktop. Historically, Desktop was favored for its speed and its robust job costing features. In 2026, while Intuit has moved most users to a subscription version of Desktop called Premier Plus or Enterprise, the core software still lives on your local computer. The biggest advantage here is data density. If you are a high-volume shop doing 50 repair orders a day, QBO can sometimes feel sluggish as it loads pages over the web. Desktop is instantaneous. It also offers more advanced step-by-step. You must evaluate your shop management systems, native integration. This is the tiebreaker. In 2026, most modern SMS platforms like ShopMonkey or TechMetric are cloud-first. They are designed to talk to QuickBooks Online via a direct API. This connection is seamless. When you click close on a repair order in your SMS, the data appears in QBO within seconds. If you try to force a cloud-based SMS to talk to a desktop-based QuickBooks, you often have to use a bridge or a sync tool. These bridges are notorious for sync errors. Imagine if your SMS says you sold 10 sets of tires, but the bridge timed out and only pushed 8 of those sales into your QuickBooks. You now have a $2,000 discrepancy that you have to find manually. Historical data suggests that sync friction is the leading cause of manual journal entries, which are the enemy of clean books. Another factor is accountant access. In 2026, most CPA firms have transitioned to a digital-only workflow. If you use QBO, you simply invite your accountant as a user. They can log in, reconcile your books, and pull your tax reports without you ever leaving the shop. If you use Desktop, you have to create an accountant's copy or a backup file, upload it to a secure server, or heaven forbid, put it on a thumb drive and mail it. This data latency means your accountant is often looking at information that is 2 weeks old. In a fast-moving economy, getting tax advice on old data is like trying to fix a car based on a scan tool reading from last month. Imagine a scenario where you want to scale your business to a second or third location. QBO makes this easy. You can set up location tracking and see the performance of Shop A versus Shop B in one single login. QuickBooks Desktop requires a hosted environment or a terminal server to achieve this, which adds another layer of technical complexity and cost. For the growth-minded shop owner in 2026, the cloud offers a scalability path that the desktop version struggles to match without significant IT investment. But what about security? Many shop owners are hesitant to put their entire financial history on the cloud. However, historical trends in cybersecurity suggest that your data is actually safer in a multi-billion-dollar data center managed by Intuit than it is on a single office computer in your shop. If your shop is burglarized and your computer is stolen, or if a technician accidentally spills a cup of coffee on the server, your desktop data is gone unless you have a rigorous off-site backup routine. QBO provides redundant backups as part of your subscription. In 2026, data loss is a risk that can end a business, and the cloud provides a significant safety net against local disasters. Consider the potential outcomes of third-party apps. The QBO ecosystem is massive. There are apps for automated accounts payable, like Bill.com, advanced analytics like Fathom, and employee scheduling like 7Shifts. These apps plug directly into QBO and share data in real time. If you want to build a tech-forward shop that uses automation to reduce administrative headcount, QBO is the clear winner. You can essentially build a custom software stack that fits your shop like a glove. Desktop has some integrations, but they are often clunky and require manual exports and imports. So which engine should you choose? If you are a high-volume, multi-location shop that values automation, accessibility, and accountant collaboration, QuickBooks Online is likely your best choice. If you are a specialized single-location shop with complex inventory needs and a preference for one-time, or at least more controlled, costs and lightning-fast local performance, Desktop might still be the champion. But regardless of which platform you pick, there is one ghost in the machine that can ruin both: bank reconciliation. Most shop owners think reconciling is just making sure the balances match. In 2026, it is so much more. It is your final defense against fraud, bank errors, and the digital handshake failures we discussed earlier. In Part 9, we are going to look at the Vault. We will show you the exact steps to reconcile your shop's accounts, so you can sleep at night knowing your numbers are bulletproof. We will also uncover the red flags that indicate something is wrong with your cash flow before it hits the point of no return. Are you ready to secure your financial vault? The next part is where we turn your data into verified truth. The financial vault is not a physical safe in your office. It is the process of bank reconciliation within QuickBooks. In 2026, where digital transactions move at the speed of light, many shop owners view reconciliation as a tedious end-of-month chore. However, for a high-performance auto repair facility, reconciliation is the final audit that ensures your digital handshake didn't drop a digit and your vendor power play actually resulted in the correct debits. If you are a shop owner like Kevin in Austin, Texas, you might see a bank balance in QuickBooks and a statement balance from your bank. If those two numbers don't match exactly, your entire financial reporting system is built on sand. To secure your vault, you must understand that reconciliation is the only way to turn raw data into verified truth. Step by step, the reconciliation process in QuickBooks involves matching every single transaction on your bank statement to a corresponding entry in your ledger. In 2026, QuickBooks uses artificial intelligence to auto-match many of these for you through the bank feed. For example, if you paid your landlord $1,500 for rent via ACH, the bank feed sees the withdrawal and suggests a match to the bill you already entered. This is efficient, but it is also where complacency creeps in. Historical trends in automotive accounting show that false matches are common. The software might match a $500 parts purchase to a $500 tool lease payment simply because the dollar amounts are identical. If you click confirm without looking, your profit and loss statement will be inaccurate, and your tax classifications will be a mess. Imagine a scenario where your shop management system synced a $1,000 credit card payment from a customer, but the merchant processor only deposited $970 after fees. If you don't reconcile, that $30 discrepancy stays on your books as undeposited funds. Over a month of 20 transactions a day, those missing $30 add up to thousands of dollars in phantom assets. Your QuickBooks says you have the money, but your bank account disagrees. By performing a daily or weekly reconciliation, you catch these merchant fee discrepancies immediately. You can then record the $30 as a bank service charge, ensuring your books match the reality of your cash flow. Let us look at a case study of a multi-bay tire center in Georgia. The owner, Olivia, was frustrated because her cash on hand always seemed lower than what QuickBooks reported. During a deep dive reconciliation of her 2025 records, she discovered that 3 vendor credits for returned tires, totaling nearly $4,000, had been recorded in QuickBooks but were never actually issued by the vendor to her bank account. Because she hadn't been reconciling the individual line items against her statement, she didn't realize the vendor had forgotten to send the money back. This is the vault in action. Protects you from the errors of others. Potential outcomes of a strict reconciliation policy include recovering lost credits, identifying duplicate billings, and spotting unauthorized subscription creep before it drains your operating capital. The most critical part of securing the vault is the uncleared transactions list. These are checks you wrote or deposits you recorded that have not yet hit the bank. In 2026, if you see a check to a parts vendor that has been uncleared for 60 days, that is a red flag. Did the vendor lose the check? Did the driver forget to turn it in? Or worse, was it intercepted and altered? Historical data suggests that internal fraud often hides in the uncleared transactions of an unreconciled account. An employee might record a voided transaction in the SMS but pocket the cash, thinking the owner only looks at the bank balance. By reconciling, you see that the cash deposit doesn't match the sales report, exposing the leak instantly. Consider the potential outcomes of fraud prevention. In the United States, small businesses are statistically more vulnerable to embezzlement because of a lack of segregation of duties. If the same person who orders the parts also enters the bills and reconciles the bank account, the vault is unlocked. Elite shops in 2026 use a 2-person rule. One person enters the data, and the owner or an outside bookkeeper performs the final reconciliation. This creates a system of checks and balances that makes it significantly harder for errors or intentional skimming to go unnoticed. Step by step, you should also reconcile your credit card accounts. Many shop owners treat their business credit cards like a black box, only looking at the total balance. However, in 2026, your credit card is likely where you pay for your software subscriptions, your digital marketing ads, and your emergency parts store runs. Reconciling the credit card ensures that every single point of sale purchase is tied to a specific job or overhead category. If a technician uses the shop card to buy a specialized tool for a customer's car, but that tool isn't job costed back to the repair order, you have lost margin. Reconciliation forces you to account for that tool, ensuring it either ends up as a billable item or a recorded shop asset. Imagine if you discovered that you were being charged twice for your digital vehicle inspection software every month. This happened to a shop owner named Mark in Colorado. He had upgraded his plan, but the software company never canceled the old one. Because Mark performed a detailed reconciliation in QuickBooks, he caught the double billing in the first month. He saved nearly $300 a month simply by paying attention to the vault. Without reconciliation, that $3,000 a year leak would have continued indefinitely. The vault also includes your sales tax payable account. As we discussed earlier, this is not your money. When you reconcile your sales in QuickBooks against your bank deposits, you should also be verifying that your sales tax collected matches the liability shown on your balance sheet. In 2026, state revenue departments are using automated data matching to find shops that are underreporting. If your QuickBooks records show $10,000 in sales tax collected, but your bank deposits only support $9,000, you are inviting an audit. Proper reconciliation ensures that your tax liability is a verified truth, not an estimate. Historical trends show that shops that reconcile their accounts weekly are much more agile during economic shifts. They know their exact burn rate, how much cash they consume every day to stay open. In a high inflation environment like 2026, knowing your burn rate to the penny allows you to adjust your labor rates or parts markups in real time. You aren't waiting for your accountant to tell you that you lost money last quarter. You know you are losing money this Tuesday, and you can fix it by Wednesday. We have now secured the vault. Your data is no longer just input, it is verified intelligence. You have the map, the machine, and the security. But there is one final step to becoming a true CEO of your auto repair shop. It is the move from looking backwards to looking forwards. All the data in the world is useless if you don't know how to use it to drive growth and maximize the value of your life's work. In the final part of this masterclass, we are going to look at the CEO dashboard. We will show you the key performance indicators, or KPIs, that actually matter in 2026, and how to use QuickBooks to build a predictive model for your shop's future. Are you ready to see what your shop could actually become? The finish line is in sight. The CEO dashboard is where the grunt work of data entry and reconciliation transforms into high-level strategic intelligence. In 2026, the American automotive landscape is shifting faster than ever with the rise of complex electric vehicle architectures and the increasing cost of high-tier technical talent. If you are a shop owner like Maria in Chicago, Illinois, you cannot afford to look at your business through a rearview mirror. You need a windshield that shows you the path ahead. Most shop owners use QuickBooks as a digital filing cabinet for tax season, but a CEO uses it as a flight deck. To reach the finish line of this masterclass, you must learn to extract the key performance indicators, or KPIs, that actually drive growth and use them to build a predictive model for your shop's future. The first KPI you must master is your effective labor rate, or ELR. This is not the rate you have posted on your wall, it is the rate you actually collect. To find this in QuickBooks, you take your total labor income and divide it by the total billable hours produced by your technicians. Historical trends show a startling gap in many U.S. shops. A shop might have a posted rate of $180 per hour, but their ELR is only $140. This $40 leak is usually caused by unbilled diagnostic time, excessive goodwill discounts by service advisors, or menu pricing that hasn't been updated to reflect current labor times. By tracking your ELR monthly in QuickBooks, you can see if your shop is actually getting paid for the expertise you provide. If your ELR is dropping while your technicians are busy, you don't have a work volume problem. You have a pricing discipline problem. Next is the gross profit margin on parts and labor. As we established in the earlier parts of this series, these are the twin engines of your profitability. In 2026, the target for a healthy independent shop is typically 65% on labor and 45% on parts. In QuickBooks, you can run a profit and loss by class or a sales by item report to see these margins in real time. Imagine a scenario where Maria notices her parts margin has slipped from 45% to 38% over 3 months. Because she has a clean chart of accounts, she can drill down and see that a specific vendor has been increasing prices on oil and filters by 2% every month, but her shop management system hasn't updated the retail price to match. This margin compression would be invisible if she only looked at her total bank balance. By catching it early, she can adjust her parts matrix and recover thousands in potential outcomes. A critical but often overlooked KPI is your average repair order, or ARO. To calculate this, take your total sales and divide by the number of invoices closed. While your SMS tracks this daily, tracking it in QuickBooks allows you to see the net ARO, after all costs are considered. Historical data in the United States suggests that a rising ARO is often a sign of better digital vehicle inspections, or DVIs. If your ARO is $500, but your break-even point per car is $450, you are barely keeping the lights on. If you can use your data to identify that your technician efficiency is high but your service advisor sales volume is low, you know exactly where to focus your training efforts. Let us look at a case study of a shop in North Carolina that focused on customer acquisition cost versus customer lifetime value. The owner, Steve, used QuickBooks to track his marketing spend across different platforms: Google Ads, local mailers, and social media. By linking his marketing expenses to new customer tags in his SMS, and then syncing that to QuickBooks, he discovered that while Google Ads brought in the most new leads, his local mailer brought in high-value European car owners who spent 3 times more over a 12-month period. Potential outcomes of this data-driven approach allowed Steve to cut his marketing budget by 20% while increasing his total net profit, because he was no longer buying low-margin customers. Step by step, the move to a predictive model involves budgeting and forecasting. In QuickBooks, you can take your 2025 actual numbers and use them as a template for 2026. You can create a what-if scenario. Imagine if you hired a 4th technician. You can input the projected labor income they would generate and the labor costs of their burdened wage. QuickBooks will show you how that hire affects your break-even point and your bottom line. This removes the fear from expansion. You aren't just hoping the new tech pays for themselves. You have a data-backed model that shows you exactly how many hours they need to bill per week to make the investment profitable. Another pillar of the CEO dashboard is the debt-to-asset ratio and return on assets. In 2026, with the high cost of specialized EV diagnostic tools and heavy-duty lifts, you are making large capital investments. Are those tools paying for themselves? By creating a sub-account in QuickBooks for specific high-ticket equipment, you can track the revenue generated by that equipment. If you spend $15,000 on a new alignment rack, you should be tracking the alignment income specifically. Historical trends show that shops that track asset utilization are much more likely to have the cash flow necessary to upgrade their technology every 3 to 5 years without taking on predatory debt. Consider the potential outcomes of inventory turnover tracking. We discussed the inventory black hole earlier, but as a CEO, you look at turnover ratio. If your inventory is turning 6 times a year, your cash is moving. If it is turning twice, your cash is dead. By running an inventory valuation summary in QuickBooks every month, you can identify slow movers and return them to the vendor before they become obsolete. In the fast-moving world of 2026, where vehicle technology changes annually, agile inventory is a massive competitive advantage. Imagine if you could see your shop capacity in dollars. If you have 5 bays and you know each bay has the potential to generate $3,000 a week in labor, your total shop capacity is $15,000 a week. If your QuickBooks shows you are only generating $9,000, you have a capacity gap of 40%. This tells you that your problem isn't your rent or your electricity, it's your throughput. You can then use your data to find the bottleneck. Is it parts delivery? Is it tech skill? Is it service advisor lag? The CEO dashboard doesn't just show you the score, it shows you how to play the game. Finally, we must discuss the exit value. Every shop owner will eventually leave their business, either by choice or by circumstance. In 2026, the multiple used to value a shop is heavily dependent on the quality of earnings. A buyer will look at your QuickBooks and ask, is this data clean? Is the profit real? Is the owner's labor accounted for? By following the masterclass steps we have laid out, clean chart of accounts, rigorous reconciliation, and granular job costing, you are building a turnkey financial system. A shop with verified truth in its books is worth significantly more than a shop where the owner says, "Trust me, we make money." You are not just managing a shop, you are building an investable asset. We have traveled from the basic disclaimer to the heights of predictive modeling. You now have the tools to determine if QuickBooks is the best choice for your shop And more importantly, how to use it like a professional. You have learned to bridge the gap between the grease on the floor and the numbers on the screen. But knowledge without action is just data noise. The next step is to open your QuickBooks, look at your accounts payable aging, and start the vendor power play we discussed. The potential outcomes for your shop are limited only by your willingness to master the mechanics of your money. The automotive industry is entering its most complex era yet. The shops that survive and thrive in 2026 will not be the ones with the biggest signs or the loudest ads. They will be the ones with the sharpest pens and the cleanest books. You are no longer just a technician who happens to own a garage. You are the CEO of a sophisticated automotive service enterprise. The data is in your hands. Now go drive the numbers.